Well, today's December 21st. We're nearing the end of a successful 2010 where the markets moved higher, actually even near our 1250 mark, which all year long we backed it off from 1300, but we thought that towards the end of the year we'd finish about 1250. And I'm happy to report that we were correct. But on the flip side of it, we also thought utilities and healthcare would perform well also. Those two sectors have quite lagged. In fact, they're break-even or even negative for the year so far in 2010. Although we are patient investors, and we think 2011 will pay its due towards those two industries, utilities and healthcare. So we continue to be invested in those. I would like to say for 2011, a lot of people are always constantly asking me, are we in a bull market, are we in a bear market, where's the market headed? Well, as we're finishing 2010, I have no reason to believe that 2010 doesn't finish positive, on a positive note. Most people have actually gone away for vacation for the holidays, so trading's light. In fact, the volatility index, which measures the volatility of the market, is actually at a significant low. It's actually near 16. And by doing that, basically it means that people are complacent with where the market is at. So whenever people get complacent, I always expect the market to either drop 4 to 5, even 6%. But I'll tell you, that would really represent one of the best buying opportunities going into 2011 if the market were to falter. Let's talk about a couple things in 2011 that we see happening. We continue to see 2011 as a great year for stocks. In 2010, you really made money if you were in more of the risky stocks. I think 2011 will be a little bit different. I think more of the broad averages will come up in terms of utilities, healthcare, and even some of the other stocks that really are still trading 20, 25, even 30% below their normal averages. As where they may have not have been the most risky stocks like Pepsi and stocks like that, which we do own in the Archer Balance Fund. But we see those stocks actually even moving higher in 2011. Again, 2011. What does it present for us? There's always the risk of inflation. Believe me, Washington is printing money like mad. That could be a sore spot for the economy, depending on what happens. Although, frankly, even though inflation's rising, the consumer price index and those type of things seem to be in check. Although I'm somewhat suspicious sometimes as to those numbers. But given that, and with the monetary supply increasing, we really should see some pretty decent times in 2011. In fact, estimates for the S&P 500 stocks are near 94. If we would just talk about historical norms and say that stocks trade around 15 times earnings, we're trading at about a 15 to 20% discount. So into 2011, as you can see, we have kind of a low barrier and a mid barrier, and I really think the stock market, the S&P 500, should finish the year somewhere around 1350 to 1400, maybe even a little bit higher. But I do think that the market's going to move even higher than that sometime mid-year before we get up to a certain point, and then that's when people start saying, "Hey, gosh, you know what? We've run too far. We need to settle back," and then maybe we'll even see a 10% correction sometime in the last half of the year. I wouldn't put that behind us. So in 2011, I want to show you a couple charts here. And these charts are from J.P. Morgan Chase, and they're really quite interesting. Is what they do is they show that any time that treasuries have outperformed stocks over a certain period of time, which you can see in this chart, that over the next 15 to 20 years or 10 years, it's really been quite positive for the stock market. And then the next chart that I'd like to show is anytime we've seen these cyclical bear markets like we've been through, what does the next 10 to 20 years represent for us? Well, forget who's in the White House, whether it's Republican, Democrat, or anybody else. The market gives us a price every day, and sometimes it's higher and sometimes it's lower. There was a period of time from 72 to 82 where, if you can see the picture of the Big Mac here, that where McDonald's, their net income almost doubled from that period of time. Yet if you invested in the stock from 1972 to 1982, you actually lost money. And that's because the market acts as a springboard. Sometimes it expands, that spring expands, and sometimes it compresses. And right now we're probably kind of that middle stage. We were compressed for a period of time. We've gone back to that middle stage. Now we haven't fully expanded. And that's what I expect to happen here. I mean, just because utilities and healthcare did what I would consider poorly in 2010, it's amazing though that their earnings on a whole actually were some of the best earnings they've ever had in the company's histories. So with that being said, I see for an expansion of that spring into utilities and healthcare, and even again some of the other sectors, for this market to spring forward. I wouldn't even be surprised to see the S&P 500 hit 1,500, which is where we were before this whole calamity struck, and the market turned down. I'm not going to say we'll hold that 1,500 number, but I think the euphoria of the market will drive a lot of people that are sitting on the sidelines to be kind of those last folks that like to go to the Colts games when they're about ready to win the Super Bowl and everybody's a fan. Everybody starts wearing their shirts at that point in time. The mutual fund market or the stock market's no different. Once the market starts moving higher, people are going to start rushing in. They're going to start buying equity funds, ETFs, and that'll push the market higher. Okay. One chart I would like to show you here on utilities and why I do believe that utilities, I expect them to do well in 2011. We're continuing to see a rising demand. And this chart is actually showing you the peak summer months, okay? And it shows you what our supply is for the utilities and then what our demand is. And as you can see through 2017, that demand is continuing to rise. Well, forget electric cars and all that. When the economy comes back, people use more in the way of utilities. They turn their lights on, the heat, they turn it up a notch, whatever. They're not cost cutting quite as much. I see that demand continuing to rise, and utilities being on the best end of the rope for that situation, because those stocks should continue to climb because the dividends will continue to climb, and if dividends get so high, the stock's going to move much higher as well. One thing just to kind of wrap this up for 2011, I think one area to avoid is long-term corporate bonds, long-term treasury bonds. I'm not convinced that the bond market, that we haven't seen maybe the biggest bubble of its time for some period of time. And I really see the bond market faltering 10-20% if you're invested long-term in treasuries or long-term corporates. We do have two new funds out, the Archer Stock Fund and the Archer Income Fund. They're both funds are meant to complement our existing Archer Balance Fund. They do take a little bit different approach, quite frankly. The Archer Stock Fund is a go-anywhere fund. There's small caps, mid caps, value, growth, kind of across the table in that fund. Obviously, we see the stocks that we put in that fund as some kind of value, and we think we're buying them at a value, but that stock fund, it is a high turnover fund. It's probably more suitable for an IRA. And then the Archer Income Fund is, again, it's a go anywhere income fund, although frankly it's designed to preserve capital. It's one thing I think you should always ask with income funds is it are you worried about a return on your capital or a return of your capital? And the first thing is we want to make sure that the capital, we have a preservation of the initial capital that goes in, and then we want to obviously have a return on your investment instead of a return of your investment. Okay. With that being said, again, I think 2011 is going to be a great year. I even think 2012 might pose some additional upside in the market. So for the next 2 years, I still feel pretty positive about the market. Obviously, I do think 2012 is going to be a much smaller year in terms of growth of the stock market. But I think 2011, I think we're really setting up for a great year. We have some gridlock in Congress. Nothing bad about Washington not doing anything. Sometimes that's always positive. So, anyways, my name is Troy Patton. I'm one of the portfolio managers of the Archer Balance Fund, the Archer Stock Fund, and the Archer Income Fund. Thank you very much, and everyone have a happy holidays, and we look forward to a successful 2011. Thank you.